we had this big move from here down here where it attacked the sell stops or sell side liquidity. What took place here? Smart money sold to the buy stops. So now they're sitting with a net short position. How did they get out of that position? They have to buy it back. How can they buy it back at a cheaper price, guaranteeing them that they're going to be buying from lower priced sellers? Find the sell stops. Here, sell side liquidity rests below here. Why are there sell stops below there? Because traders have models that want to capture these types of moves and expect things like this high to be taken out before they start trailing their stop loss. I'm teaching you liquidity. I'm showing you that market efficiency paradigm where you are being trained to go into the marketplace and look at how liquidity that is resting in the market or will be engineered to be there where you want it to be. What's that mean? Above old highs. Those buy stops are being triggered. So smart money can go short. They're selling short to these buy stops. And they're going to buy it back from resting sell stops that are resting below here, sell side liquidity. All right, so we're looking at this area here where it drops below this old low. It does it here and here on a shallow basis, but then we have this real nice decline yesterday on Monday's trading. So I want to take you into this right here and kind of like build on the idea of what liquidity does once it takes out old lows like this. What can it do? So we're zoomed in on Monday's trading here. Here's Friday's trading. And I want to take your attention to last 3 days, the open, the high, the low, and the close. In the last 3 days that are not necessarily where you might expect. But I'm also going to incorporate some of the things like rebalancing. And then where does this formation form? I want to take your attention into this candle here, last Friday's low. So if this was Monday, go back the last 3 days. You go here, here, and here. Now, is there a fair value gap in that? No. But look what Monday's trading did. It opened, extended down, and closed near the low. It was a rather large range today. Okay, great, wonderful. What do you do with that information? If you go back to the previous day's low, this is going to be important because if you do this, the next trading day, if we open up, and because we're below those relative equal lows on the daily chart, and we're below this swing low also, we're now in a deep discount. So when you see a big down day like this, all the indicators are going to flash oversold. Oversold. Okay. I'm not trying to pick a bottom, but indicator followers will look for a bullish divergence because they think that they're going to catch the ultimate low and they're going to ride it up. Even if they were lucky to buy the low, the chances of them holding it long term, not likely. So it's a fallacy to try to pursue that. Don't think like that. When we have a bias, if any of you are trading, try to avoid trying to pick the tops and the bottoms. There's a lot of meat in between the major turning points. But I want to take this idea here and we're going to drop down into a lower time frame after we see today's price action trade right up in here. Now this looks like an indecisive day. So if you're looking at a daily chart, it can be a little confusing, like, what took place? This is a mixed day, they'll call it. No. Let's go into this formation right here. Okay, I'm going to give you some logic. In perspective, you want to break your daily ranges up by the day. And I taught that midnight starts the crossover to a new day. So at midnight here on Tuesday, we start here. The opening price is here. If you draw that out in time, it goes up, it goes down, and then it comes right back to close to where it opened up at midnight. And it would get very close to what that daily chart showed, that indecisive candle, where it was a lot of wick to the upside, a little bit of wick down to the downside, and a small little body. Okay, that looks indecisive on that time frame. But if you look closer and you start framing out the things I've taught you, here is relative equal highs, old low. What's resting above relative equal highs? Buy side liquidity. What's resting below an old low? Sell side liquidity. The market runs above at 9:30. It hits that old low. That red line here, that old low, it hits that there, right at 9:30. Then, all of the buy side is purged. That means all of these buy stops have now been drug into the market by their hair, kicking and screaming. They're in. They're caught long, or they've been short and they've been knocked out of their short position. Either way, it doesn't matter to us. We just know that that buy-side liquidity is likely to be utilized to set up an idea for smart money to be short. Why? Because the bias is bearish. We have not changed gears. We're not trying to pick the bottom. So if we're doing this like smart money, and we're looking at the market like this, and we want to be short up here at this trigger event, which we'll look at in a moment, where would you want to offset that short position? Well, you have a nice little short-term low here, so you can take partial below that. It hits it beautifully, and the previous day's low, and it does that run below that low here just as handsomely as it did here. So let's go in and use the logic with this idea of rebalancing Monday's daily range, keying off of this level here. Notice that the buy side liquidity is ran first. This is really important, folks. If we would have gone down and took the previous low out, then ran up here, that to me is not bearish. This, running above buy side liquidity here at 9:30, hitting that without having this low taken out, that is bearish because it's within the context of the bias that we're looking for. When we're operating in a bearish bias, what we're essentially saying is the market's going to go up to a premium for one of two reasons. Run an old high or highs to take out buy side liquidity, so that way smart money can counterparty with them with their short positions. They're going to sell to those buy stops. Then seeking to buy cheaper sell side liquidity. That would be their pool of liquidity to offset, distribute their shorts below here. So they're going to sell here at a high price and buy it back at a cheaper price. This is not a random unknown low. It's in the marketplace. As soon as that day closed, that low is known to everyone. But the liquidity resting below that is not necessarily a target or a utilization for anybody in any other retail idea. That's what I'm trying to shake you by your lapels and say, pay attention. I'm showing you how to look at the marketplace like smart money. The second pool of liquidity is the sell side liquidity. So it runs the buy side first with the bearish bias. So it's doing what I taught in this mentorship. It goes up to a premium, then seeks a discount. See that? Now we're going to drop into a 15-minute time frame. And now I have added the 8:30 time frame here. And we have the relative equal highs. The market at 8:30, we're looking for what to happen? The news embargo to lift. That means that the algorithm will start seeking liquidity as early as that time frame. Now, it might wait till 9:30, and this candle here is 9:30. Notice it hits it right there where we're drawing your attention to, because it's rebalancing that entire Monday range. It's going back to the previous day prior to Monday, its old low on Friday. So when you see that, it rebalances the big drop on Monday. It tricks people into thinking that it's made the low and it's going to keep going up, when the only thing it has done is it's gone up to a logical level on that daily time frame that rebalances all of that sell-off on Monday. It's been rebalanced. So if you look at the 9th on the 15-minute time frame, this does not look like it's an imbalance. But on a daily candle, it's a large down day. So all of this movement here is big in terms of distribution on the downside. This is a retracement back up into a logical level, which is Friday's low. And it hits it based on the elements that I taught you. And it's following what the logic is that I shared publicly in this series. Look for relative equal highs. At 8:30, it's going to start looking for a high or highs to run. That's these over here. How far can it go? That's that Friday low. There's your framework. This is that Judas swing, that fake rally up. Okay? Think about what the daily candle looked like before we start dropping down in lower time frames. It was a big wick up and a little bit of a wick down, but it was a small little body on the candle for Tuesday's trading. But if you look at it from the lens of Power 3, how I teach you the accumulation, at 8:30, use the opening price that's down here, draw that out in time. The rally should take place above that, hits a logical level I'm teaching you. Then it creates the pattern that's in the mentorship, fair value gap, market structure shift. Then it starts to show displacement and distribution to the downside, attacking a discount array. So This is your power 3 where it opens, rallies up, creates the high, and trades down. There's your move, power 3. But it's inside that daily candle that looks indecisive, right? So you have to understand what you're looking at relative to time and price. When you do that, it takes away all that confusion. It provides more clarity. We're going to drop down into a 5-minute chart and start building this into a very visual representation of what you've been learning in this series. Midnight New York. News embargo at 8:30 is lifted. Now, there wasn't a whole lot of news this morning, admittedly, but this, still the same logic. Relative equal highs at 8:30 starts the algorithm. What's it going to do? It's going to run for a premium. Why? Because the bias is bearish. It's going to return likely up into that Friday low to rebalance Monday's trading. Its bearish candle was being rebalanced. And at 9:30 a.m., the equity market opens. That's what this little manipulation is, okay? What is 9:30? That's when you expect this little type of a move. But it begins at 8:30. So that hour-long interval, we're expecting, when we're bearish, a run higher to set up shorts. Now, the short can form inside that hour, or it could just provide the leg that sets up the framework that will eventually, like I'm going to show you here, provide you the setup. So all of it is a matter of studying what the market's providing you. It doesn't change the rules. I'm not bending the rules. I'm giving you the logic behind when these algorithms do what they're doing. When price starts to spool from 8:30 up into Friday's low, at 9:30, that's that manipulation time where they create that little opportunity where it looks like it's going to do something, but it's generally the opposite of what it looks like on the chart. In other words, retail is going to see that as it's breaking out, it's going higher, and they're going to want to buy it and chase it. And then they have their hinder parts handed to them. And then they just run the daily range against them to take out the sell side over here. Okay? But I want you to look inside this 5-minute run here and notice that this whole area shaded here, that's the Judas swing. That's the fake rally in a down move that will be profitable for shorts. But at the time, retail won't see that. They won't identify it. It won't make any sense to them. They'll be caught off guard. But I want you to go into that range here. This, right here, that is your displacement price swing. That right there, that's the leg on a 5-minute chart. You strip that down and you start going from 5, 4, 3, 2, and 1 until you find your fair value gap. The 40, 44 and a half level is equilibrium, or 50% of the range between the high and the low that run here, that drop down. Why am I noting this? Because we have this swing low broken here. Now, it could have stopped there and started to move up, and we would use that range from here to here. But it just kept breaking lower, lower, lower. So it broke below this low and what looks like this low here. So it was several short-term lows that were broken. Nonetheless, this is the displacement price leg. So this price swing here, you shade that while you're learning, and then you start breaking that down into the lower time frames. So right now we're on the 5-minute chart. I'm going to keep this shaded area here on, but we're just going to transition from the 5-minute chart down to the 4-minute chart. So here's the 4-minute chart. 9:30 is this candle here. That's your Judas swing. At 8:30 it starts its run. This is the algorithmic price run. Goes to Friday's low, rebalances the entire range on Monday's trading. It changes the narrative when retail traders thinking it's created the low. All the bullish divergence they would be seeing on their indicators and such, they're screaming to buy, and breakout artists are looking at this break here because they think this is resistance broken now. Oh, it's coming back down to it. What is this? Resistance broken, turns support, right? Okay, it breaks down a little bit. Okay, then it starts to run. Okay, well, it was just one of those instances where it was, went past a little bit, but it's still going to go higher. You can almost read into the price action what retail would be expecting here. But we're looking for something very specific. In this shaded area here, we're looking for a fair value gap. Do you see a fair value gap? Some of you would say this. Yeah, I didn't know that. You read my mind, ICT. Why not that one? What would happen if I went into that and sold short? Well, first of all, if you did that, you were not following the rules, because from this high down to that low, this is equilibrium. We need to get to a premium. We don't want to sell in a discount. That's not what we're doing here. So we have to get to this level here, 40, 44 and a half or higher. That's a premium based on that price swing. So there's no 4-minute fair value gap. On the 3-minute chart, inside this pink shaded area, that's the displacement leg, is there a fair value gap? There is no fair value gap here either. So you drop down into your 2-minute chart. Okay, do you see a fair value gap in the 2-minute chart? Lo and behold, the unicorn. Here's the fair value gap. Small little imbalance right in here. And we took out the short-term low. Now, some of you might see this if you were watching the 2-minute chart. Okay, say you watched the 2-minute chart and you saw this short-term low broken here, or maybe this one here, and you saw this. Is this displacement? One could argue, perhaps it is. Okay, now I'm going to give you the alternative. This movement lower creates that fair value gap. Yes, we have a short-term low taken out there. Okay, this entry on this fair value gap, if you utilize that, where would your stop loss be? It would have to be at least above the candle that creates the fair value gap. That's this one here. So your stop will be above here. Did it hit it? No. But you cannot, listen to me folks, you cannot open a trade up like this and put a stop above here and watch it go down here and want to trail your stop loss real tight. You can't do that. You have to hold with a certain measure of risk open. So how do you do that? We're going to talk a little bit about stop placement now. Initially, when it opens the trade up, the rule is you want to use the candle that creates the fair value gap that high, just above that. Okay, 1 tick, 2 ticks above that. That's sufficient enough. If you are scared and you just want to use a nice, handsome, ample stop, you would use the swing high here. Oh, that's a lot of movement. So what? They have micro account positions that you can trade with. But once you place your stop here or here, when do you start moving your stop? Well, you want to see a larger shift in structure. When this low is taken out down here, then you can move your stop down. Say it was up here, then you can move it to here. Okay? Or maybe here. Why? Because it's already broke down. So it's not going to go down here and come back up here. If it does, then you're probably wrong. Or it's going to consolidate, which means it's going to be an ugly condition to be working within anyway. See the logic there? I'm accepting the fact that I'm probably going to be wrong if it stops me out, but who cares if it does? Why would I have that opinion of not caring if it stops me out? How many times have you seen this pattern form? It's forming somewhere every day. Okay, it's forming everywhere. Either in the London session, overnight highs and lows, or it's forming in the New York session. I'm teaching you the New York session because you have the advantage of knowing what took place in London. That's why I'm teaching this. Does it work in London? Absolutely. Does it work in Asia? Not that often. And that's why I haven't pushed hard for Asia. So here's what we have. We have the whole model identifying a setup, moving back to a rebalance of Monday's price range back up to Friday's low, hitting that level there, and then creating the setup that's happening at the time elements, the same way I teach it in the series. And here it is. Boom. Comes in, hits it, breaks down, pairs up with the sell side liquidity. Smart money sells short here, and then adds to it here. Trades into here during the lunch hour. Your limit order, if it was used, would be filled during the lunch hour, not around 12:30.